Around a year ago, I talked about the good and bad of universal life insurance, and I get a lot of great feedback asking to share more. So in today's video, I want to share 5 things that you must know when you look into a universal life insurance. So at the time when you're ready, you can make the best judgment if this is right for you. Hey, this is Thomas. We have the most Vancouver life insurance 5-star Google reviews, and this channel is to help Canadians build tax-free wealth for their retirement and to protect you and your family using solutions that Canadian banks don't want you to know about. So enjoy what I have for you, and let's get started. Let's briefly recap what universal life insurance is. Universal life insurance is a form of permanent life insurance that is ideal for people who want flexibility. It's also ideal for young people who are a bit tight on budget but still want insurance, as term insurance will expire and become ultra expensive when you choose to renew at age of 50 or 60. It contains 2 parts. There's a death benefit component and there's the investment component. For the death component, it's tax-free lump sum payment to the beneficiary should the insurer pass away. And for the investment component, there's a wide degree of freedom where you can choose how to invest, from guaranteed term deposit to stock market index fund. It depends on your risk tolerance. And because Universal Life has a very high transparency, you know exactly the cost of insurance and how much you put into the investment. Especially before 2009, before TFSA was introduced, a lot of investors loves it, because the money in the insurance plan can grow tax shelter, and if done right, it can be tax-free too when they withdraw the saving from it. Alright, now there are 5 things we need to watch out for before committing to a universal life insurance. Number 1. What do you want in an insurance policy? When considering life insurance, it's always important to understand why you're looking for it in the first place. Are you looking to cover a mortgage, leave a legacy for the next generation, or pay your final tax bill? Many Canadians may not realize that with the right insurance planning, you can actually accomplish multiple goals at once. For example, if you're a business owner, you might be looking for a way to protect your company while also utilizing tax shelter features to save more for the company. All these factors will play a role in determining how to set up your plans. It's also important to keep in mind that despite the additional benefits that life insurance may offer, the primary purpose is protection. And that protection comes at a cost. However, when done right, your insurance can become an asset class, meaning you will receive more than what you put in. Alright, next is the cost of insurance. There are 2 choices in terms of the cost structure. You can choose between level or yearly renewable term. Level means the cost of the insurance is fixed from now until the day that you pass away. YRT means that every year they will increase the cost of insurance as we are getting older. The beauty of YRT is when we are young, the cost of insurance is much cheaper compared to a level plan. Let me give you an example. John is 30 years old, married. He's interested in universal life insurance because he wasn't sure about his upcoming expenses, so he wants the flexibility. For a level cost universal life insurance, the cost for $500,000 is around $300 per month. Where if John chooses YRT, the cost starts at $60 per month for his current age, and the year after is around $62 per month, and the year after maybe at $65 per month. Yes, the cost of insurance keeps increasing, but it takes John to reach age of 60 to age of 65 to start paying that $300 for the cost of insurance. So which one should you choose, level or YRT? Using John's case, if his budget is $400 per month and decides to do level cost universal life, at age of 65, he will have around $140,000 in cash value and $252,000 at the age of 75 based on a 5% return on his investments. But if John chooses YRT, the cost of insurance is $60 and he can use the remaining $340 for investments, and therefore he will have around $400,000 at age of 65 and $700,000 at age of 75. So it really depending on your age and how much money you like to invest. If you are young and have investment knowledge, YRT will be a better option. That's because we can leverage the youth to get the lowest cost possible and invest the difference into the markets. where if you're hitting your 50s or 60s and want to lock down the cost instead of increasing it over the years, the level will be a better option. Also, the downside of YLT is that if you don't invest enough into your insurance, one day the cost over the insurance side should be higher than the investment side. And I do see a lot of cases like that. The agent just sold the client a YLT Universal Life but put all the investment into a saving account. As a result, when the client is getting old, the return from the investment cannot cover the cost. Since Universal Life Insurance is a permanent life insurance, you pretty much need to keep paying until the day that you die. Yes, you can access the premium holiday options, which you can use the cash value to pay for it, but there's still the risk of policy lapse when there's not enough money in there. And yes, for level premium, you can further upgrade it to pay off in 10, 15, or 20 years, meaning after 20 years, you're done with the payment and you own a permanent life insurance policy. However, I usually won't recommend it as there's a huge cost. I'd rather use that money to invest and keep it in your own pockets. The beauty of Universal Life Insurance is that you can control how much you want to put into the plan. Looking back at John's case, he can choose to put in $200 this month, and when he gets a bonus or tax return, he can choose to put in $2,000 next month. Now, you might wonder why you should pay more than the minimum amount possible. Well, there's a good reason for it. Think of this Universal Life Insurance like a coffee mug. You can put water, tea, or coffee, which represent the savings and investment inside the insurance policy. The money inside this cup is tax shelter, which means that it is protected from the CRA. And just like how the size of a cup can be tall, grande, or venti, the size of the insurance coverage can be adjusted to suit your needs. The bigger the cup, the more tax-free money you have in your insurance policy. If you look at a tax-free savings account, you can only save a limited amount of money without paying taxes. Every year, the amount you can contribute to your TFSA increases by $6,500. And if you're a high-income earner, you will likely reach that contribution limit quickly. Or if you're new to the country and don't have a lot of tax-free saving room but have a lot of saving, you might want to consider Universal Life Insurance as a way to invest without having the CRA come after you. This is why Universal Life Insurance is often referred to as the rich man tax-free savings account. It allows you to create additional tax shelter savings bucket beside your tax-free saving or RSP. This is especially useful for business owners who want to save more money in the corporation while minimizing their tax burden as there's no corporate-owned TFSA. Alright, let's move on to number 3, which is the death benefit payouts. Nobody likes to think of their death, but this is when the policy is most useful. When it comes to the death payout of a life insurance policy, there are mainly two choices to consider: death benefit only or death benefit plus cash value. With a death benefit only option, the payout is the agreed face amount upon the insured's death. On the other hand, with a death benefit plus cash value options, the policyholder might have to pay slightly more per month, usually around $2 to $5, but in return, they will receive both the death benefit and the money saved inside the plan tax-free. This means that if the person passes away, their beneficiary will receive both the death benefits and the cash value accumulated in the policy, providing them with the additional financial security, and it also solves the inflation problem. Okay, now we are on to the number 4 things that you need to watch out for, which is the investment choices and return. Now for the investment portion, you have a variety of things that you can do. You can use it for savings, term deposit, and fixed income or equity-based funds. As long as the insurance company has it, you can buy it. Your range of yearly return per year can be varied from between 1 to 20% depending on your risk and market performance. With the current interest environment, GIC is around 5% now, which is not bad. However, is this feasible for long term, given the interest rate will not be this high for the next 10 years? On the other hand, having equity fund like an index fund, long term, it should give you a great return. But what if the market is down at the time that you need the money? Therefore, it is very important to my next point, the insurance company and the advisor him or herself. When evaluating a life insurance company and the advisor who will help you out with the process, there are several factors to consider. One important factor is both the company and the advisor's track record with investments. It is important to determine if they have a history of making sound investment decisions. Additionally, it's essential to ensure that the advisor has compared at least 2 to 3 insurance companies to identify which one offers better performance in terms of cost of insurance and consistency of investment return. Furthermore, it is important to consider how easy it is to access your account balance and statements. You want to review your policy at least semi-annual basis, so you want an advisor who conducts regular reviews with you. Also, if the policy is set on a yearly renewable term, it is important to consider the projections when you stop contributing and if there are enough funds to back up the plan. A lot of insurance advisors out there may say universal life is the silver bullet for everything. Well, just like any other investments, it's not for everybody. It has downsides as well. If you compare it to a whole life insurance, there's a lot of variables on the investment side in the universal life insurance, especially if you're choosing YLT. Because universal life insurance is market dependent, it can fluctuate with the market and drop just when you need the money the most. Think back in 2008 or 2022 when the stock market dropped around 20%, and most of the investment inside universal life insurance policy did as well. If you compare that to whole life insurance, even in a down cycle, they still pay out at 5 to 6%. And for most of the time, universal life requires lifetime contributions. So if you are planning for retirement, this is also going to take in effect. To wrap it all up, if you're thinking about universal life insurance, there are a couple of things to consider in advance. Do you want to choose YLT or level? What kind of investment would you like to choose? And more importantly, will your insurance advisor going to review the investment performance with you from time to time? Or you have those agents that never come back to review? I personally have both whole life insurance or universal life insurance coverage because then I can have the best of both worlds. But I do find universal life insurance especially beneficial if you're young and looking for asset accumulation. It's transparent and you're more in control. Alright, as usual, I hope you learned something from this video. Please share this video with your friends or family who are looking for insurance and comment below if you have any questions. I need your feedback to make the videos better. Hey, thanks so much for watching. This is Thomas, and I will see you in the next video.